In the meantime, let's talk markets this morning ahead of the opening bell and the final trading day of the year's first half. Joining us for that is Sam Stovall. He's chief investment strategist at CFRA. It has been a big first half and a big month. We were quoting some numbers earlier about how the Dow has had its best June since 1938. What does this mean? What do you think?
Well, I did a little number crunching and went back to World War II and basically found that on average, the second half, the market goes up about 4% and has risen 69% of the time. But whenever the first half was up by 10% or more, then the frequency of advance went from 69% up to 80%, and the average price change went from 4% to 7.5%. Obviously,
that's the opposite of what you might expect. If you're getting big gains in the first half, you may think you pulled it forward, but that's not the case historically?
No, what it says basically is that momentum begets additional momentum, and that the market itself wants to move higher. Now, of course, you still have the traditionally challenging May through October period, especially July through October, following very strong advances on a year-to-date basis through April. We were the third strongest going back to World War II. History then warned us, be careful, May will probably digest those gains, which it did. Look for June to be up, because it was up 100% of the time during those 5 strongest since World War II. And now you can add this month to it. But then it says, be careful, the July through October period is normally down 80% of the time. And we then see a pickup in November and December.
So that instead of having sell in May and go away, maybe this is a sell in June and go away?
Could be, absolutely. So you exclude May, which was down, threw us into another correction, a decline of 5 to 10%, which I call a pullback. But yeah, I think it basically implies that we're not out of the woods just yet. The summer winds could be turning into summer headwinds. And so we have to worry, have we gotten ahead of ourselves in terms of the Fed cutting interest rates in the end of July? Now S&P Capital IQ is forecasting an earnings recession because second quarter earnings are expected to be down 1.5%. Third quarter earnings are expected to be off 0.3%.
You think that's going to be the case because people were thinking we were going to see an earnings recession in the second quarter, in the first quarter?
I think, well, it's going to happen one of these days. But,
yeah, but timing kind of matters.
Fool me once, shame on you. Fool me 29 times, shame on me, because in each of the last 29 quarters, the actual results exceeded end of quarter estimates, and they did so by an average of almost 4 percentage points.
Sam, thank you. Great to see you. Have a
My
great
pleasure.
weekend.
You too.